we are going to present our research on value investing and momentum strategy. And our introduction can be divided into 5 parts. Firstly is investment philosophy. Our investment philosophy is combine the value investing and momentum strategy. And secondly, how market works. The market works well because everyone has its demand. Like company has wants to raise money for its investment. For the investors, it can buy shares based on the value investing and momentum strategies. Next, I will introduce the value investing and momentum strategy separately. Like Fama and French found the evidence on value effect, which simply about the investing in stocks that are priced lower than indicated by a fundamental analysis of the company. As to the momentum strategy, Jagdish and Tickman found the evidence on the momentum effect, which based on the theory that the established trends of the stock price will continue. Finally, we combine the value investing and momentum strategies. These two strategies can work in different periods, and it is a relatively comprehensive method to the long-term equity investors, both capturing benefits from the analysis and avoiding risk under the single mode. And the second part is existing evidence on momentum and value investing. And we got 4 evidence on momentum and value investing. All of them have confirmed the combination method are well performed. Firstly, Ring and Johnson found the combination method performed well in individual market level for all types of markets. As to the sales to price and the book to market ratio are the best criteria. And John and Jask found that the combination strategy can less short-term volatility and grab more excess future returns. Thirdly, based on Greg, Ronnie, and Sheridan research, the combination strategy is beneficial to investors since it can lowering turnover and transaction costs and utilizing the negative information in long-only portfolios. Finally, according to the Julio and Marcus research, momentum is the dominant factor of outperformance.
In this part, I'll explain the trading system that includes the methods applied to select the securities and the scheme of weighting the portfolio stocks. The selection of securities is totally based on the value investing and the momentum strategy, for they can obviously indicate the fundamental value of stocks. There are some criteria when we choose the securities, such as the market to book ratio, price earnings ratio, and dividend yield. According to the Bird and Whitaker 2003, we decided to use price earning ratios and market to book ratio as variables. In this way, securities are selected according to the cheaper stock price, but not the expensive ones. And market to book ratios play a role in explaining the cross-sectional variation in stock returns. It indicates that the individual stocks with a higher ratio represent the lower future stock returns. The Sharas, Chandra, and Thompson 1994 gives the justification that this ratio predicts the future stock returns, for it shows the book value proxies for future cash flows. The price earning ratio shows a negative relationship between the ratio and the future stock returns, so we just need to invest the portfolio with the lower ratio. Momentum investing is rather a good technique way to predict the future stock returns based on the historical returns. Annual average return is a quite important indicator shows this strategy. In our analysis, we select the securities starting in 2006 and ending in 2018 based on the above 3 criteria. We take the 2006 as an example, and we screen the securities by ranking the price earning ratio and the market to book ratio separately in the stand of top to bottom, and mark the stocks which have relative high ranks. And high ranks means the high returns. The left stock we need to choose are picked based on the individual ranks. In a similar way, we rank the average returns in the stand of bottom to top and highlight the companies that has the high returns. And by combining these three measures, we can determine the 20 outperform companies. When weighing the portfolio stocks, we estimate the market-weighted returns, and the returns are obtained by weighing each stock in each portfolio on the basis for its contribution to the market capital of the portfolio. And the weight is equal to dividing annual stock return by annual total market capital.
Next, we are talking about the evaluation of portfolio performance. Firstly, we have selected three ratios, which are Sharpe ratio, Jensen alpha, and information ratio, to evaluate our statistics. Firstly, higher Sharpe ratio indicates higher premium for additional risk. So the Sharpe ratio of our portfolio is 0.38, which is higher than the market. Secondly, the Jensen alpha, which is defined as abnormal return of managed portfolio over the theoretical expected returns. The positive Jensen alpha means that our portfolio is deserved to invest. Thirdly, the information ratio recognizes excess returns generated from excess risk over benchmark. The positive information ratio of our portfolio means that our portfolio is outperformed than the market. Next session, I will introduce global factors causing time variation. As you can see from the picture that our portfolio generated positive returns during the period from 2006 to 2017, of which the highest return is incredibly over 4% in 2009, despite of negative returns incurred in 2010 and 2013. It can be found that in 2008, our market return is dramatically negative, which can be attributed to the global financial crisis. Also, adversely, our portfolio earned positive returns, which can be because we choose some companies like Caltex, Australian, DPG, which compensate the losses. During the following years, market tends to recover. In 2009, our portfolio generated a relatively high return because we invested 27% to FMG companies, which generated 4.7% returns. In 2009, inversely, our portfolio generated negatively high returns, mainly because we invested 29.6% to real company. In 2011, the value of Australian stocks lost nearly $35 billion, which resulted in a decrease in the average market return. Next comes to our conclusion. The result of momentum and value strategy in our portfolio performed well, which is consistent with our academic studies. The portfolio can achieve significant diversification gains under combined strategies. Thanks for your guys watching.